The economic dynamics between the United States and China are becoming increasingly strained, with continuous trade policies and financial strategies marking a new era of rivalry. During the Trump administration, the US adopted a protectionist stance aimed at strengthening its economy and protecting domestic industries. This included imposing substantial tariffs on Chinese imports, ranging from 10% to 20% on most goods and up to 60% on specific items. In response, China countered with its own measures, shaking global trade and economic stability. One of China's significant moves came in January 2025 when its Ministry of Commerce announced export restrictions on critical technologies essential for manufacturing battery components and refining key minerals like lithium and gallium. These measures are designed to consolidate China's dominance in the global battery supply chain and critical mineral markets. As of 2022, China controlled 72% of the world's lithium refining capacity, further bolstered by investments in countries like Chile, Canada, and Australia. Such restrictions are a double-edged sword. While they strengthen China's strategic control, they also pose challenges for Western producers reliant on Chinese technology for lithium chemical production. Additionally, these constraints could slow the expansion plans of major Chinese battery manufacturers like Eve Energy, which depend on international markets. China has been working to globalize its currency, the yuan, to reduce dependence on the US dollar and gain greater financial independence. In 2010, the yuan accounted for less than 1% of China's global transactions, while the US dollar dominated with 83%. By March 2023, the yuan surpassed the dollar in China's cross-border transactions, reaching a 48.4% share. By 2024, this figure rose to 52.9%, underscoring a steady shift. To achieve this, China has implemented various strategies, including currency swap agreements with over 40 nations and the introduction of the cross-border interbank payment system. This system provides a secure alternative to the SWIFT network, enabling efficient yuan-based payments. The yuan's rise is particularly evident in regions like the Middle East and Africa, where economic ties with China are robust. For example, over 70% of China-Russia transactions are now settled in yuan, following Russia's exclusion from SWIFT in 2023. Despite these advancements, the yuan's global presence remains modest compared to the US dollar, which still accounts for 58% of international reserves. The structural barriers like China's capital controls and opaque financial systems hinder the yuan's broader adoption. If you're enjoying this exploration of US-China economic relations, give this video a like and share it with others interested in global geopolitics. China's financial strategies also include reducing its holdings of US Treasury securities. This aligns with its de-dollarization goals and efforts to diversify foreign exchange reserves. By early 2024, China cut its treasury holdings by over $21 billion, dropping to $76.1 billion, the lowest since 2009. This marks a significant shift from 2013, when China's holdings peaked at $1.32 trillion. Several factors drive this trend, including the desire for monetary policy independence and concerns over US debt sustainability. With US public debt surpassing $33.4 trillion in 2023, China's shift reflects its cautious stance on long-term investments in US securities. Chinese banks have also reduced their dollar assets by 22% since 2021, signaling a move toward greater reliance on the yuan in trade. Japan, like China, has been reducing its US Treasury holdings, cutting over 21% since 2020. The combined actions of these two economic giants have implications for the US economy. Large-scale sell-offs of US Treasuries could flood the market, driving prices down and yields up. Higher yields raise borrowing costs for the US government and businesses, potentially slowing economic growth. Simultaneously, a weaker dollar might make US exports more competitive but also drive up import prices, fueling inflation. What do you think about China's economic strategies? Are they a smart move for long-term independence or a risky gamble? Share your thoughts in the comments below. Understanding these dynamics requires a look at the historical context. Japan's isolationist Sakoku policy, which lasted over 2 centuries, ended abruptly in 1853 when Commodore Matthew Perry of the US Navy pressured Japan to open its ports. The Treaty of Kanagawa in 1854 marked the beginning of Western influence in Japan, leading to modernization during the Meiji Restoration. Over the next century, US-Japan relations evolved through periods of cooperation and conflict. Economic sanctions and tensions over Japan's expansionist policies culminated in World War II. Post-war, the US oversaw significant reforms in Japan, democratizing its government and fostering economic growth. This relationship laid the foundation for a strong alliance during the Cold War and beyond, as Japan's industrial prowess complemented America's security guarantees. Today, the economic ties between the US, China, and Japan are undergoing significant transformations. Reductions in US Treasury holdings by major creditors could increase borrowing costs, weaken the dollar, and spark market volatility. For the US, this raises questions about the sustainability of its fiscal policies and its ability to attract foreign investment. These shifts also highlight the delicate balance of economic independence in a globalized world. The evolving financial strategies of China and Japan underscore the complexities of modern geopolitics and global economics. Their move to reduce reliance on the US dollar and Treasury securities reflect broader shifts in the balance of power. For the US, navigating these changes will require adaptive policies that address domestic economic challenges while fostering international cooperation. Understanding these dynamics is crucial as the global economy becomes increasingly interconnected. Will the yuan emerge as a true rival to the dollar, or will structural barriers prevent it from reaching that level? The answer to these questions will shape the future of international trade and finance. If you found this analysis insightful, don't forget to like, subscribe, and ring the notification bell for more deep dives into global economics and geopolitical trends. Thanks for watching.